Hi everyone, Joe Gentili from Left Tail Risk Advisors. In this video, I want to focus on giving some tips to families that are considering funding a special needs trust for their child with life insurance or they already have. And the tips are going to draw from my years of litigating life insurance cases on behalf of policyholders against life insurance companies. And so having that perspective as a litigator versus just simply a life insurance broker or agent, I have the perspective of seeing the problems that arise in insurance policies over time rather than just looking at them at the point of sale or the point of contract and just kind of looking at how they illustrate versus how they actually perform. So, since I have a unique perspective, I want to share some lessons that I've learned through that over the years. So, first, if you're looking to fund a special needs trust with life insurance or you already have, this is a really major financial commitment, both in terms of money and in terms of the importance that this works out properly and correctly. That if you're buying these life insurance policies, you want to be sure that when you pass or when you and your um, spouse or co-parent pass, that the money is there to fund the trust for the child when that happens. So very important that the outcome occurs as planned with the funding. So some of the pitfalls that I see are related to the types of life insurance policies that people use. And so there's a few common types that have pitfalls that we see. So first, I just want to mention that there's a lot of people fund with term life insurance, at least initially. And there's a couple of good reasons to do that. Number one, permanent life insurance is a large financial commitment, and not everybody has the resources upfront to fully fund their life insurance needs with permanent life insurance. And so term life insurance can be a great way to make sure that you have coverage in place while you're building the capacity to fund a permanent life insurance policy and also to lock in your insurability during that time to make sure that assuming you're healthy today and you're looking to fund a permanent life insurance policy in a few years, that that plan is not going to be interrupted because there's a change in your health. So one thing to look at that's very important with a term life insurance policy is the conversion privilege, the conversion options in that policy. So many people, when they're shopping for term life insurance policy, they're just price comparing. They're looking for a 20-year term policy with $1 million death benefit, let's say, and they're looking at what the carrier charges and going with the lowest cost. That is not necessarily the way to go about this because the conversion option is very, very valuable. Some policies give you a longer period of time to convert to a permanent policy than others. That's one thing to watch for. Another thing to watch for is that some companies have just like these conversion only permanent policies that they let you convert to. And to be honest, most of them are priced very poorly. So you want to favor companies that give you a wider range of options to convert to. Some companies will allow you to convert to pretty much any permanent policy that they have. So that's a very important thing to be mindful of. Next, universal life insurance. So universal life insurance, index universal life insurance, spent a lot of time litigating cases involving these. Um, Unfortunately, have talked to a lot of people who have funded policies for decades, only to have those policies either require a very large amount of money to keep in force later on, or to lapse after retirement. And these, if you're in the special needs planning world, this is nothing short of a catastrophic outcome that you want to avoid at all costs. So, for people who are looking to buy a policy now, very important to understand the following with the universal life insurance policies. The premiums are not guaranteed in those policies. So what that means is that when you're shown a policy illustration, you're given a target premium with an IUL or universal life insurance policy that assuming that the policy performs under assumptions that the life insurance broker or agent is creating, then the target premium is enough to keep the policy in force for life. But those assumptions are just that, they're assumptions. And a lot of times, if you have an agent or a broker that wants to make a policy look favorable, they're going to use rosy assumptions. And unsurprisingly, a lot of times those rosy assumptions don't come to pass. And so, what happens when rosy assumptions don't come to pass is that over time, you're not accumulating enough cash value to keep that policy in force for life because the cost of keeping that policy in force goes up every year with that type of life insurance policy. And so it's very easy to end up with a situation where you fund the policy just like the broker or agent told you to fund it for decades, only to have that policy collapse later in life. Very big problem that you want to avoid. One way you could avoid that is with using a different type of life insurance, like a whole life insurance policy, where the premiums are guaranteed. As long as you pay the premium, the policy stays in force. It's pretty simple in that respect. People are steered away from those policies for a number of reasons. Sometimes it's cost related because they are more expensive upfront to have a life insurance policy. Those guarantees do have a cost. So it's one reason. Another reason is because universal life insurance sometimes illustrates better, meaning that there's different assumptions that they could put into the illustration of the policy that make them look better on paper, even though, again, they're just assumptions. So you really want to be mindful that if you're looking at a policy, whole life insurance policy has guaranteed premiums, universal life policies do not, unless they're guaranteed universal life insurance policies. But in general, universal life and IUL do not. And so that takes me to the second issue that we see is that it's very important to be aware that life insurance is not a set it and forget it product. You are not done with that life insurance. The planning is not done when you purchase it. The policy has to be monitored over time. Some types of policies require more monitoring than others because their design is more complex. Universal life insurance is more complex than whole life insurance, so it requires more monitoring. One thing I would like people to be aware of is that there's a risk that at some point in your life, because hopefully you're going to hold this policy for decades, you're going to be monitoring this policy on your own. There is not going to be somebody looking over your shoulder telling you what to do with it. So you want to make sure that one of two things happens in that scenario. Well, um, hopefully both. When you buy the policy, you are aware that simple policies carry less monitoring risk, more complex policies carry more monitoring risk. So, all things being equal, you should favor simple because it has a higher probability that it's going to stay in force for life, which is what you need. So, keep that in mind when you're looking at policies. Simple has value. The other thing is that you need to be proactive about making sure that that life insurance policy is monitored and that somebody is looking at it, if not every year, every other year, but periodically those policies need to be monitored. Why? Again, with the universal life insurance policy, you want to make sure that there's enough money in going into that policy that it will stay in force for life. It's very easy for that not to happen if it's not being monitored. Then also any type of life insurance policy. You're going to want to see that the ownership structure is correct, that the beneficiaries are correct, that you have an appropriate amount of coverage. Sometimes that the needs change over time. So all policies need to be monitored, but some more frequently than others. So for if you've already bought a life insurance policy, and it's a universal life insurance policy, it's an IUL or a UL, and you're using that to fund a special needs trust, very, very important. I would suggest that you get a policy review done by a professional to make sure that there's enough premium going into that policy, that there's enough cash value in that policy to keep it in force for life. Because again, the last place you want to end up with one of these policies is that you're looking at a very, very large need to infuse cash into it later on in life, post-retirement, or that you have a lapse later on in life. Again, I can't think of a situation with life insurance where the need for the policy to perform to be in force on the death of the parents for the special needs child is more important than this scenario. So very important to have those policies monitored to see if the policy needs more cash, to see if there's a better alternative that's available, given that you already have this policy, whether there's more coverage needed, less coverage needed, whatever the case may be, it needs to be monitored because it's not a set it and forget it product. So those are some of the lessons that I've learned from litigating cases, some of the things that I've seen go wrong frequently over the years with people with life insurance policies where problems have developed later on. A lot of those problems can be addressed up front with proper planning to understand the value of guarantees in a life insurance policy, to understand the value of conversion privileges, and to sort out which are valuable and which are really just illusory. And also to make sure that the policy is being properly funded, that people that buy the policies understand that there's more risk inherent in getting a more complicated policy versus a simpler policy. And then for folks that already have policies in place for a long period of time, if there is a problem with the policy, if it's being underfunded, let's say through no fault of the policy owner, they just are funding according to the target, but the target's no longer enough. Those problems are much, much easier to address early than they are to address later, which is why monitoring is so important. Problems that are fixable and addressable with not a lot of problem early can become really big problems later on. So that's what I have today. I hope you found this useful. If you have any questions about this video, I encourage you to reach out. If not, I encourage you to like and subscribe for future videos on the topic. Thanks. I hope you have a great day.